Good day and welcome to Money Smart, where we explain every finance and banking concept so you can be a much smarter investor and the master of your cash flow. Okay, guys, so today is probably one of the most exciting episodes I've ever done because I'll be discussing an investment strategy known as the split strike conversion. And I personally feel that this is a marvelous strategy which any investor can use. So, if you've followed along with my last podcast episode, you would know that this strategy was initially made famous by Bernie Madoff when he claimed to have used it in his pyramid scheme. After doing that episode, I did a lot of research on this. I broke down the strategy into several components and pieced it back together one by one in order to get a clearer picture. And what I found out was mind-boggling. It's such a simple strategy, but yet so effective that you can assure yourself that you can make a profit irrespective of market conditions. So how does this work? Well, let's find out right now. So a split strike conversion cuts losses by using an option. An option is basically an instrument which gives the holder the right but not the obligation to buy or sell the underlying shares. What do I mean by this? Well, let's take an example. Suppose you have bought an option for one share of $2 for the duration of 1 year. This means that in this time span of 1 year, depending on how you see the stock performing, you can decide whether to buy or sell the share or leave it and forgo the trading of the share. And during this time, the seller of the option is paid a small premium by you. So you would ask, why is this used? So an option is basically used because I'm digressing little bit, but only if you can understand how an option works, can you understand the split strike conversion process. So basically, in an option, you can agree to buy or sell the share at a particular strike price. So keeping to that same example, if I buy an option for a strike price of $2, that means that irrespective of the market, when I want to exercise the option, I will buy or sell the share only at $2. So let's say the market is down right now and the share price goes down to, let's say, 0.5 cents. Even though that's the case, I will still trade my share for $2 because I'm using this option. So that's how it works. And as you can see, depending on the right conditions, market conditions, you can make a good profit by using them. Okay, so first I'll go through the 3-step process of a split strike conversion. Then I'll explain the important terms, and finally I'll end with an example so that by the end of it you will know exactly how a split strike conversion works. So the first step in the strategy is to buy shares that follow a particular index such as the S&P 500, the Nasdaq Composite, or any other index. The second step is to sell call options at a strike price that is above the current share price of the share you have bought. The third and final step is to use the premiums that you have collected from the call options to buy a put option on your share at a price that is as much or below as the current share price for your share. So this will all be clear in the example that I give you. For now, let's move on to the important terms. Okay, so the first term I want to explain is an index. An index is basically an average of a particular financial market or a market segment or some of the top companies. So an example is the S&P 500, which shows you the average share price of the 500 largest public companies in the US. So the reason we use these index prices to buy the shares for split check conversion is because most of the time the performance of these indices can never be beaten. They can never be outperformed. So if you were to invest in an index, your investments are relatively safer. Okay, moving on. The second term I want to explain to you all is a call option. Remember I explained options to you all earlier? Well, a call option is only to buy a particular share, not to sell. So if I want to buy a share in 3 months, but I'm not sure of how the market is going to be at that time, I will go and buy a call option for a share worth, let's say, $5. In 3 months, if the market is performing badly and this share is only worth $2.50, then I am under no obligation to buy the share. I can just forego it. However, if the market is doing really well and the share price rises to $7.50, I can buy the share for the same $5 from the seller, and he is obligated because I'm exercising this option. Now this is a profit for me because I buy it from the seller for $5 at the strike price, and I can immediately sell it in the market for the current price, which is $7.50. So just like that, I'm making a $2.50 profit, which is really good. Now the third term is a put option. This is basically an opposite of a call option, wherein we have the option to sell the underlying share. So let's say again I already have a share that's $5 and I want to sell it in 3 months. Now if I have a put option and in 3 months the market is performing badly and share price goes to $2.50, I can exercise the option and sell the shares to the seller of the option, and thus I can make a profit of $2.50 because I'm selling shares that are worth $2.50 for the strike price of $5. And if the market does perform well, then for the most part I'll be facing a loss. So as you can see, depending on how the markets are going, I can choose whether I want to exercise this option and trade in the shares. So it's very useful. The next term I want to talk about is premium. So when you talk about premiums, think of an insurance company. We want insurance, so we pay these companies a premium for coverage. So in the same way, we need to pay the seller of the option a small premium for whatever duration that we are holding the option for. So that's basically a premium. And a strike price is basically the price we use to trade a commodity or an investment, irrespective of market conditions. So I guess you would have understood that by now. So these are the most important terms you need to know. Now let's take an example to completely clarify any doubts that you'll have. So let's say I buy shares, let's say I buy one share of $10 that follows the S&P 500. Okay, then what I do is I sell a call option on this $10 share at the strike price that's above the current share price. So let's say I sell the call option at a strike price of $13, and an investor B, buys it. And in return, investor B pays me a small premium, let's say $1. Example. Okay, that's done. So now we move on to the third step. With these premiums that I'm collecting from investor B, I will buy a put option on my share at a strike price that is as much as the current share price, which is $10 itself, from, let's say, investor C. And I am using the same premiums that I'm collecting from investor B on the call option to pay investor C. Got it? So now there are two scenarios. We are in the future now. There are two scenarios that can happen. One, the market performs badly and my share price is now only $5. I bought the shares for $10, now it's $5. What happens? So when the shares are at $5, I will exercise my put option and sell my shares to investor C for $10. In this way, I am making a profit of $5 even though the market is down, right? Because right now the value of the shares are $5 in this future, and I'm selling it to investor C for $10. So just like that, I am making a $5 profit. Okay, so second scenario. What happens if the share price goes up and the market's performing fabulously? Let's say the share price now in this scenario is $15. Well, obviously investor B would want to exercise his buy option. So he will buy the shares from me for $15. So this is very easy, right? I have bought the shares for $10, and now when the shares are at $15, investor B wants to buy it. So again, like that, I'm making a profit of $5. Oh, wait, I'm sorry. Investor B wants to buy his shares for $13. So I'm still making a $3 profit. So now this is the perceived disadvantage of a split strike conversion. I'll talk to it in a bit. So now, as you can see, in both the scenarios, irrespective of whether the markets are doing very well or very badly, I am still profiting from both scenarios. Now let's talk about the limited gains of the split strike conversion. So as I mentioned in the example, even though the markets were doing very well and the share price was $15, because the strike price of the buy option was only $13, I could only sell the shares at that amount. Now you might argue saying that this limit of gains is actually very bad because we have the potential to earn much more. Well, to that I would say, yeah, I agree. But what would be better? To have an investment where there is a 50% chance of loss and unlimited gain, or an investment where there is 50% of gain but zero loss? I feel the second option is much better because something is better than nothing. And actually, I thought of this alternative where if you wanted to spend a little more, you can just forego selling the call option and you can directly buy the put option from your own money. So, in this way, you are cutting your losses as well as you have the potential to earn unlimited gain. So, that's one thing I thought of, but I have to do a bit more research on this to see why other investors haven't used it. I mean, obviously, there are more experienced investors and financiers who know better. So, they would probably have used it if it worked. So, I'll research on this and I'll probably discuss it in a future episode. Okay, guys, so this was basically how the split strike conversion works. And this is probably the longest episode that I've done. It's around 17 and a half, 18 minutes. So I hope you'll enjoyed it. I hope you'll found value in it, and I hope you'll finally understood how this strategy works. If if you'll have any doubts, queries, or want to give me any feedback, do follow me on Instagram at moneysmart911. And also, I am planning to start a YouTube channel, and in that I'll be explaining this concept again, so that with the video it'll be much more clearer to you. So if you have any doubts, you can just refer to that video. So I'll be letting you all know when the channel will be launched in my Instagram. So be sure to follow me on Instagram. My account name is moneysmart911. I'll see you all in the next episode. Good day.